There is a huge difference between the business that grows and requires lots of capital to do so, and the business that grows and doesn't require capital. This is the biggest secret in Warren's buy and hold forever strategy. If you buy and hold a business that requires lots of capital to grow, your stock is never going to grow in value. The reason is the constant drain of capital just to keep the business from sinking in the wake of competition. If you have to spend billions redesigning your product mix every 5 years, those are billions that can't be spent expanding operations or buying new businesses or buying back stock. But a business that can grow without new infusions of capital can afford to spend its excess cash doing those things, all of which will increase the company's per share earnings, which will in turn cause the company's stock price to increase. This is why Warren prefers companies like Wrigley's and Coca-Cola as opposed to GM or Intel. Companies like Wrigley's and Coca-Cola never have to spend billions redesigning their product or retooling their manufacturing plants, which leave them plenty of money to spend on such things as buying back their own stock. GM or Intel, on the other hand, have to constantly spend billions on new designs and retooling. If either one stops spending billions on new designs or retooling, it would be put out of business by its competition. If a business needs lots of capital to grow, it will never make you rich. And if it doesn't need lots of capital to grow, it won't ever leave you poor.